Volatility concerns looming over Wall Street today. Markets weathered a sharp downturn over concerns again about technology. Our next guest says be careful catching knives. Let's go to Sam Labell, Portfolio Manager, Veritas Asset Management. Sam, thanks for joining us today.
Thanks. It's been an interesting day. So
it has been interesting for sure. Was there any obvious trigger in the pullback in tech today?
So we've been seeing over the last week or two that there's been sectors that have been kind of targeted by investors for the AI's disruption narrative. The first, it was legal software. Insurers came under fire as these tools are released. People look at the individual sectors and they say, oh, well, this has the potential to disrupt my sector. Maybe these valuations are a little rich. And then there's a bit of a sell-off. So today, actually, it was logistics companies. No obvious piece of news or obvious technological tool that triggered that. But the narrative is here with AI that because you're able to program at a lower cost, you can develop features and software at a much lower cost. The moat that was created by being the first mover in software, developing, getting something up to speed and launching it, that created a nice moat around your business that made it harder for a second mover to come in and compete with you. Well, that's kind of gone. And in fact, it allows a lot of different players to add features that can compete with you. And so the thought is that by lowering the programming costs, that kind of creates a more competitive environment across all industries, potentially damaging profitability, potentially causing some of this pressure that you're seeing. It used to be thought that AI was just going to universally improve margins. But now I think people are starting to realize that, no, this could increase the level of competition and could ultimately be a threat to your pricing power and to your market share.
Okay, so
and they're not really sure how to deal with that.
Let me get into a couple of stocks with you, because I want to know whether you think investors are discounting the amount of data that some of these companies privately hold, all right? The amount of insight they have that perhaps is building a separate moat. Let's dive into some of the software stocks. Shopify, of course, an e-commerce platform. They reported, they've done well. Stock is down. Would you pick it up where it is today?
Shopify is a great company, and we've always said that it's got a growing market share of e-commerce. They reported it's reportedly up to 14% of the U.S. e-commerce market, up from 12% just a year and a bit ago. So it's growing that share. It had a great quarter, revenue growth 31%, and guided for further growth in Q1. But the problem with a lot of these software names is that they have an adoption curve, which they call the S curve, and it kind of describes how the revenues grow. At the bottom of the curve, there's not a lot of people using it, and then suddenly everybody's on board. They keep adding customers. There's a huge rapid growth phase. But then once your installed base is larger than your annual additions, you're at the top of the S, and you sort of slow your growth. And the market has a real problem evaluating when that leg of the top of the S is actually going to happen. It's really about adoption as kind of a normal distribution. So you're estimating the peak of a normal distribution, and it's hard to do that. But there's kind of a consensus that's setting in about software as a service firms that they're reaching the top of that S curve, and that means slower growth going forward. So if a company has been growing at 25 or 30%, much higher multiple than if the market starts to adjust to thinking that the long-term growth rate is 10 to 20%. And I think that's really what's happening with Shopify. If you look at their trailing free cash, it's about $2 billion of trailing free cash. So they're trading at around 71 times that number. That's very high multiple, but for a company that could grow at 20% for 10 years, that's a fairly valued multiple if they can continue growing at 20% plus for 10 years. But what we're seeing is that the market is much more skeptical about how long these streaks can go on for and whether or not they should pay for a winning streak of 5 years, 7 years, 10 years. So Shopify has dropped from, I'll move over to PE multiples, maybe a little easier to describe, but it was trading at over 100 times PE and has now dropped down to 57 or so times PE. Yeah. And unfortunately, it could go lower because it's really a perceptual issue about how much growth can they sustain and what should we pay for it. And their peers are all also seeing multiple contraction.
Okay, I have about a minute left. So I know you like Brookfield infrastructure right now. Can you give me a quick synopsis of why?
Yeah, so for investors who are looking for something a little safer, I mean, after today, with a lot of different corrections happening across the markets, It's nice to look for something that maybe could provide you a bit of growth and a little safety. So Brookfield Infrastructure is kind of a growthier utilities play. It does have some exposure to the build out of data center construction and ownership. But they have several divisions: utilities, transport, midstream, and all of those segments are growing. We think that they can sustain 10% plus distributable cash flow growth through 2027. The yield's just under 5%, so you're getting a good solid growth, 6 to 10% on the earnings side, and that yield. So that's somewhere that's interesting, perhaps, for somebody who's looking to de-risk the portfolio.
Okay, Sam, got to leave it there, sir. Thanks for your time. Sam, portfolio manager at Veritas.